Andrew Romans, The Entrepreneurial Bible to Venture Capital, Inside Secrets from the Leaders in the Startup Game. Dive into the world of venture capital and startup investment with our summary of The Entrepreneurial Bible to Venture Capital, Inside Secrets from the Leaders in the Startup Game by Andrew Romans. Explore the ins and outs of how venture capital firms function, the role angel investors play in a startup's growth, and the importance of a strong management team. Learn about the significance of product innovation and viral potential for startups, crucial points for crafting a viable exit strategy, and how to refine your pitch to secure the much-needed investment for your business.
Understanding venture capital. Venture capital is private sector funding for new companies. In exchange for an investment, VC firms receive a share of a company's equity. The market has grown with the rise of startups, and technological innovations have lowered startup costs. VC firms take risks with investments, betting on a future payoff. Only a small percentage of startups are successful, but VC firms are willing to take the chance for the potential payoff. Inside venture capital firms. Venture capital firms are structured as limited partnerships, with general partners investing in projects alongside limited partners. Their ultimate goal is to make a profitable exit, with the VC firm taking around 20% of the final sale or public valuation. To cover expenses, a management fee is retained annually. The general partners, managing directors, and partners are the ones to contact when seeking investment. Angel investors, a boon for startups. Learn how angel investors, individuals who invest in young companies, help startups grow by providing needed financial support and networking opportunities. Every startup needs cash to get off the ground, and one way to secure investment capital is to find an angel investor. Angel investors are wealthy individuals who invest in companies to help them grow. They provide financial support without demanding much in return, and their investments often open doors to lucrative networking opportunities, putting startups in a better position to secure further funding from venture capital firms. Interestingly, wealthy individuals first appeared as angels in Los Angeles in the 1920s when they financed the first Hollywood films. Since then, business angels have been growing in significance and power. In 2011, the total investment made by angel investors surpassed that made by venture capital firms. If you have a startup working on a cure for cancer or for any other cause with high costs, you might need a small investment from an angel investor to finance your first lab trials. This investment could be a stepping stone to getting funding from a VC firm. However, it is important to note that angel investors usually invest from $500,000 to $1 million in a single project, just enough capital to push a startup through its first year. In summary, angel investors play a significant role in the growth of startups and offer a valuable option for entrepreneurs seeking investment. The importance of management in startups. The key to startup success is not just a great business plan but a well-rounded management team with the right skills. Venture capitalists invest in people, not just ideas. A strong and balanced team is crucial to face unexpected challenges and respond to market needs. Silicon Valley success stories typically involve a visionary leader, a technician, and a salesperson. The founding trio of 3DFX, a computer graphic card pioneer, included a visionary expert on polygonal mathematics, a 3D mathematics professor, and a senior sales vice president. If a startup lacks a key position, it may not have a well-balanced management team. VC firms also like to see at least one founder with a solid technical background. In essence, a startup with an impressive management team is a safer and more attractive investment for venture capitalists. Avoiding common pitfalls for startup success. A successful startup requires more than just raising capital. This summary explores the importance of focusing on developing a compelling product that fills a market niche, identifying and anticipating market needs, and creating a plan for building a community around a product or service. Startups should allocate resources to building value into their products rather than pouring money into early marketing. Additionally, innovation must begin by identifying market needs that customers aren't aware of yet. An excellent example of this is Steve Jobs, who was well known for his futuristic thinking. Finally, it's essential to create a plan for getting your product to the right customers and having viral potential. Mastering the art of exit strategies. Learn the art of creating an exit strategy that attracts potential investors and emotional buyers. This summary highlights the importance of developing a sustainable business, understanding how potential buyers will view your startup, and capitalizing on competition to seal better exit deals. Startups aim for profitable exits to attract venture capitalists. The key to this is having an excellent exit strategy, as it shows investors that you're aware of their goals. To develop a sustainable business, focus on steady revenue growth and acquiring loyal customers. Despite its complexity, you can create a winning exit strategy by positioning your startup as a strategic asset for potential buyers. Having a good business idea is one thing, but knowing how to sell it is another. Google had an incredible offer of $1 million to buy their company from Excite, one of the first internet portals in the early 90s. Unfortunately, Excite rejected the offer, seeing that Google had no revenue at the time. This demonstrates how investors perceive potential investments. The best deals come from emotional buyers who have an urgent need to incorporate your company into their business. An additional round of venture capital funding could help you better negotiate a sale and boost your company's market valuation, as seen in the Instagram case. Also, knowing how your competition will view your startup could help you seal better exit deals. In conclusion, creating a successful exit strategy is essential for the continuous growth of your startup. It ultimately uses your startup as a strategic asset in the eyes of investors or potential buyers, which will result in profitable exits. Pitching to venture capitalists. Entrepreneurs seeking financing should be concise, prepared, and thorough in their pitch to venture capitalists, VCs. Lengthy business plans are out. VCs want clear, snappy summaries and bullet points that address key issues. The executive summary, just 1 or 2 pages, should highlight financial requirements, the management team, developmental stage, and future goals. Supporting documents, such as a slide deck, are also helpful. However, a financial model, with 3 to 5 years' worth of data covering important issues such as revenue, costs, and net results, is essential. A good model must account for all factors affecting profitability, such as customer numbers, raw material prices, and rent increases. Finally, entrepreneurs should be ready to launch quickly and make significant changes, if necessary. With today's information deluge, it's crucial to make a good impression and not waste the time granted by VCs. Perfecting your pitch. Preparing and delivering an impressive pitch is crucial for securing financing. Be concise, unique, and authentic when describing your idea. Tailor your pitch to the audience and invest in storytelling skills. Avoid jargon, buzzwords, and defensiveness during Q&A.
In The Entrepreneurial Bible to Venture Capital, Andrew Romans equips readers with key insights into the functioning of venture capital firms and angel investors, and emphasizes the importance of effective management teams for a startup's success. By understanding the crucial elements of a successful startup, such as product innovation and viral potential, entrepreneurs stand a better chance of securing investment and creating sustainable businesses. The book also highlights the value of creating a viable exit strategy, paying attention to competitors, and developing a strong pitch. These critical takeaways from the book reflect the integral role that venture capital plays in the startup game, and the importance of anticipating the ever-changing market needs.